Okay, so let's pick back up in chapter 14 with the different types of repayment structures for these loans. We're getting toward the end of 14 and about to roll into 15 here. Page 414. And I really don't differentiate these chapters. I just kind of roll from one straight into the other because it's really all the same thing. I think they would have just called it finance, except they realized it was too long of a chapter, so they had to split it up somewhere. The most common repayment plan for a mortgage is the fixed rate level payment plan. So the interest rate is going to stay what? The same over the entire life of the loan. The interest rate does not change, which obviously is a large benefit because if the interest rate doesn't change, then the payment itself stays the same. And that's what we mean by fixed rate level payment. The payment is going to stay the same over the course of the loan. And there's an important word here. This is the borrower begins to build equity with the first monthly payment. So I want you to put a definition down for the word equity. We're going to talk about it a lot for the rest of the class, just to make sure you've got it. But equity is the value of the property that's not financed. Say it another way, it's the difference between what my property's worth and what I not bought it for. What I owe. My equity at any given time is the amount of money I would walk away with if I sold my property and paid off the mortgage. Does that make sense? So, in other words, if I could sell my house for $300,000 and I have a $150,000 mortgage, then I have $150,000 in equity. It's just the difference between the value currently, right now, of my property and what I owe on that property. So when we say you have a fixed rate level payment loan, you're building equity from the first payment. What that means is that you're paying the mortgage balance what? Down, and presumably the value of the property is either staying the same or going up. So the kind of test question you might see about equity is, how do you build equity in a property? Well, it's not just one answer. There's a multitude of ways. What's one answer to building equity? Make your payment. So pay the mortgage balance what? Down. That's one way to build equity. How else do we build equity?
Improvements.
Make improvements to the property. Fixer-upper, right? They make whole TV shows about this. When you improve the property, if you raise the value and your finance stays the same, haven't you increased your equity? Because remember, equity is the gap between what it's worth and what I owe. Here's my equity. Well, if I make improvements to property, what happens to the value? It goes up. What happens to my financed amount? Down or stays the same at bare minimum, right? So this gap is larger, so my equity went up. Does that make sense? So we said, pay down the mortgage, make improvements to the property. Does some equity buildup take care of itself? Think about the market right now. What's happening to home values? They're going what? Up. So if my home value is going up just because of appreciation and my financed amount is staying the same or going down every month, am I not also building equity that way? So 3 ways we could build equity. Pay down our mortgage balance, make improvements to the property, or just through market forces. The market is going up, appreciation would create additional equity in our property. We call equity something else when we first buy a home. What do we call equity at purchase? The down payment. Because it's the difference between what it's worth, the purchase price, and what we borrow, right? That's our down payment. So your down payment is your equity at purchase. Over time, we hope that equity is going to increase. That's the goal anyway. How do we feel about the word equity? Okay? We could also do an interest-only loan. These are called term loans. Term loans are interest-only. What's happening to the principal balance, or rather what's not happening to the principal balance if you have an interest-only loan? It's not changing. It is staying the same. There is no change whatsoever in the monthly or total balance owed on that loan on a monthly basis, because the only payment we're making is the interest that's accrued on that loan over the course of that month. So if we were doing our little chart, the total payment would be equal to the what? The interest. So in that principal box would be 0. Does that make sense? You know the chart I'm talking about? You know, when you're calculating how much you pay in the balance down. So a term loan, the total payment and the interest number would be exactly the same. So the loan balance does not change. Why? This is the question you always have to ask with finance. Why would somebody want that kind of loan? What's the one advantage to a term loan over, what do we call it when we pay the balance all the way down to 0? Test you from Tuesday. What do we call that? Fully what? Fully amortized. So what's the advantage of getting a term loan rather than a fully amortized loan? What is the borrower going to notice that's different?
The payments start low and then they escalate.
No, they don't escalate. They stay the same. Not an adjustable rate. Just term. There it is. Why do we get a term loan? Because if I'm not paying the balance down, what is my payment going to be in relation to that fully amortized payment?
Lower.
It's going to be lower, right?
Yeah.
So the motivation of doing a term loan is simply a lower payment. Could that dictate whether somebody could afford to purchase or not afford to purchase? Absolutely it could. Now, keep in mind, I am not advising you to go out and get a term loan on your house. I actually happen to think that's a horrible idea for most people. Most of these lending products exist because there are specialized circumstances that might call for it. I'll give you an example of the kind of specialized circumstance where it might make sense to do a term loan. Let's say you have a buyer that comes to you and they are fresh out of medical school. So they have to do a residency for a couple years. And maybe they're going to be a cardiologist. Cardiac resident might make 75 grand a year. What is he going to make once he's not in his residency any longer, or she is out practicing in private practice? $500,000 or more. Does that make sense? Let's say this cardiologist, she already is married and has a family. Is it possible that she could want to get into a home and settle right now versus wait until she makes the more money? So could she be interested in potentially doing a term loan right now to keep the payments as low as possible, knowing that when her income goes substantially up, she'll refinance into a more conventional type mortgage, a 15 or 30-year fixed rate? Does that make sense for everybody? A fully amortized note? Okay? So that's an interest-only loan. We could also have adjustable rate mortgages. And keep in mind, we could, in theory, combine a lot of these features. You could have adjustable rate, interest only. Now that gets funny, right? Because now not only are you never paying down the principal, but your payment could do what on a monthly basis? It could fluctuate, could go up or down, on the down part, right? Which way do they go? They go up. And here's why we always laugh at that. Why? Again, that question. Why would somebody get an adjustable rate mortgage if they, assuming they had access to both? Because there are going to be times when you don't. Commercial finance, for example, is almost always going to be adjustable rate notes. You're very rarely going to see fixed rate notes available on commercial finance. It's almost always adjustable rates. But assuming you're buying a home and you have the opportunity to do a fixed rate or an adjustable rate, why would somebody choose the adjustable rate where the payment could go up versus the fixed rate?
The initial rate might be lower.
Not might be. The initial rate is lower. The only draw of an adjustable rate is a lower what? A lower interest rate and therefore a lower payment. The draw of that adjustable rate is the lower payment. We recognize that lower payment may be for a limited amount of time, but people might say, well, I'm going to refinance. For example, I might get a 5-year ARM. ARM just stands for adjustable rate mortgage. The 5-year part is what we call the adjustment cycle. Adjustable rate mortgages have adjustment cycles. So if I say I have a 5-year ARM, then that rate can only change once every 5 years. So what that means is that whatever that initial interest rate is, I'm locked in for 5 years. So could you see how that would be attractive to somebody potentially? Let's say if they're looking at fixed rate notes and they're at 4.5%, and they look at an adjustable rate, they can get one at 2.5%. And they know they can stay locked into it for 5 years. And maybe they're thinking, heck, in 5 years I'm probably going to sell this house anyway. Would that be a draw potentially for them? Of course, the downside is always that if they stay there past that adjustment cycle, that rate could adjust higher than a fixed rate note would be at that point in time. You don't need to know all of the terminology associated with ARMs, but you do need to know the adjustment cycle, okay? And you need to understand that adjustable rate mortgages have protections built in that sometimes aren't really a protection. For example, adjustable rate mortgages usually have a rate cap. Your rate, or a payment cap rather, payment cap. They might also have a rate cap, but they might have a payment cap. Your payment can never go above this amount. Well, folks, that could be a problem actually. Because what if the rate adjusts to a point where the payment should be higher than that amount, but the payment is capped out? Guess what happens? You're not even covering the interest of accumulating on that thing any longer. So what's your loan balance doing on a monthly basis? It's increasing because the unpaid interest is being added back. So payment caps are not necessarily a good thing on an adjustable rate mortgage. They usually do have adjustment caps, so they can only adjust so much per cycle. You know, like one of the most common ones in the home arena in our area is the State Employees Credit Union loan. State Employees Credit Union does not do fixed rate mortgages. They do adjustable rate mortgages, and their ARM is a 5-year ARM. So that means the rate is locked in for how long? 5 years. And theirs can adjust a maximum of 2% per cycle, and then it would be locked for another 5 years. That's one of the more common ARMs that you see in our area, and that's a very common, very popular one that a lot of people use who work for the state, have access to State Employees Credit. There's some reasons, we'll talk about the reasons why it's such a popular, in a little bit. They usually wouldn't have a prepayment penalty, and sometimes they can be converted to fixed rates, but not very common. I don't think you need to know anything about graduated payments, so I'm going to skip over that. But we did talk about, and do need to talk about, balloon payments, which are on page 416 in your book. A balloon payment. What did we say a balloon payment was? Sorry? What's left over at the end. So what kind of loan are we talking about? Partially what? Amortized. Because fully amortized means when we get to the end we owe what? Zero. So partially amortized means when we get to the end we owe something more than zero. And that something more than zero is going to be called a balloon payment. That's the idea of a balloon payment. So again, the why question. Why would somebody do a partially amortized loan rather than a fully amortized loan? Lower monthly payments. Does that make sense? So you need to know how to make those comparisons on the test, because that's the kind of questions they're going to ask you. What's the motivating factor? Why is somebody getting a partially amortized adjustable rate note? Well, because they're trying to really limit their what? Their monthly payment. You know, those two things combined, could that really limit a monthly payment in the beginning? Could that have the potential to really get to be runaway ugly later on though? If it's already partially amortized, meaning you're going to have a balloon payment at the end, and the interest rate is adjustable, could that get ugly in a hurry? In a hurry. Just to give you an idea of how much rate changes can change things. Think about a 1% rate change on a $250,000 mortgage. That's an extra $2,500 a year in interest. So if that rate goes up by 1%, you're talking an extra $200 a month in house payment. Is that a substantial increase? It's a big one. It's a big one. We also want to talk about buy downs. Buy downs happen when the initial interest rate is being bought down. Now, it's not a discount point. Remember, discount points are buying the rate down, correct? But discount points buy the rate down for how long? The life of the loan. So if it's a 30-year mortgage and I buy discount points, how long have I reduced the interest rate on that loan? For 30 years. Buy downs are very temporary. So again, what's the motivation with a buy down? To get the what? Lower. That monthly payment. This is the ugly secret of the building industry right here. Borrower walks in, buyer walks in, Fabian walks in, he's going to buy him a house from MI Homes, Drees Homes, Pulte, Syntex, one of the big builders. Do they almost all have their own on-site lenders there?
Oh, yeah.
Yes. And when Fabian looks at the purchase price, he says, oh, I can't afford this. And the on-site lender says, sure you can. Your payment on this house would only be $1,400. And Fabian's looking at a $350,000 house going, how in the world could it only be $1,400? Well, I'll tell you why. Because the builder is buying your rate down. They're doing a 3-2-1 buy down. So they're buying the rate down 3% in year one. So whatever the rate should be, drop it by what? 3%. Guess what's going to happen in year two? It's going to only be bought down by 2%. And in year three, it's only going to be bought down by 1%. And in year four, it's only going to be bought down 0. It's going to go back to its natural rate. So let's think for a second how that's going to affect Fabian on that home purchase. In year one, that $1,400 payment is wonderful. Now, he's borrowed $300,000. When the interest rate goes up an extra 1% in year two, his payment's going to go up $260 a month. And then what's it going to do in year three? It's going to go up another $260. And then year four, another $260. So by year four, he's now paying $800 a month more. That $1,400 payment has turned into a $2,200 a month house payment in the span of 3 years. Is that going to be a problem? That is the ugly secret of the home building industry. And why would the builder do that? What does it incentivize people to do? Buy, but not only buy, but buy at higher what? Price points. It qualifies people because here's the thing. They're going to qualify him for that mortgage based on the payment in year one. Not what the payment will be in year four when that rate's reset, but what it'll be in year one. Is that going to be a discussion you might want to have with him if you're his real estate broker and say, do you understand what you're getting yourself into here? Because unless you plan to get some pretty substantial raises over the next couple of years, it's going to be a problem when your house payment is $800 more a month. See what I mean? That's a buy down. That's a buy down. So it's a temporary reduction in the interest rate. All right? New construction, very popular with new construction. You very rarely see those in resale homes, but you see them all the time in new construction. Go ahead, Lee.
How would you find out if they did the buy down?
Oh, they'd have to disclose it to you. Lynn's question is, how would I know? They would have to disclose it to you. Yes?
How do the Fed announcements on interest rates affect home borrowers' interest rates?
So when the Federal Reserve raises interest rates, and we're about to talk about this in the next chapter, so it's a timely question. The Federal Reserve does not directly set mortgage rates. What the Federal Reserve sets is something called the discount rate. The discount rate is the rate at which banks can borrow money from each other, and more importantly, from the federal government. They call it the discount window. Banks can go and borrow money from the federal government, and they have to pay it back, and they have to pay it back with interest. Well, the Federal Reserve sets that interest rate. When you hear about the Federal Reserve changing interest rates, that's the rate they're changing. So when the Federal Reserve raises that discount rate, what that means is that Bank of America now has to pay a higher interest rate to borrow money from the federal government. And mostly, what is Bank of America borrowing money for? To do what? Turn around and loan it out. So if Bank of America is having to pay a higher interest rate to lend that money out, what are they going to pass along in their loan products? Higher interest rates. So that's why when you see the Federal Reserve take action on interest rates, it ripples through everything related to finance, because ultimately that's where the lenders are getting the money to lend out. They're going and getting it. They're either borrowing it from each other through the discount window, or they're borrowing it directly from the federal government. And so if they pay a half point higher, then they're going to pass that along to consumers. So it does have a ripple through effect. It doesn't happen instantly. It usually takes a couple days, maybe even a week, for rate changes to ripple through. Both ways, up and down. But it will eventually wash through. They don't set home mortgage interest rates, but they certainly impact them because whatever they do comes out on the back end. That help? That answer your question?
Yeah.
Okay. So before we go into chapter 15, I want to show you, and this is not part of the class, but I think you'll find it interesting. We talk about a lot of different loan products in the secondary mortgage market in this next chapter. And so I think it's interesting to look at sort of where we came from. Now this video is dated now. The video was done in 2009, I believe. It's a 60 minutes video, but it gives you a very good idea of some of the lending practices that went on that led to the mortgage meltdown. And I think it's important that you understand sort of what happened so that some of these things will make sense about why that necessarily might not be a good idea. Okay? It's not a long video. All right?
So we don't need to know about the
You don't need to
The
grow
mortgage
into
industry destroy itself and set off.
All right.
How did the mortgage industry destroy itself and set off an economic collapse that ruined the finances of millions of Americans? Executives tend to hold themselves blameless, saying that no one could have seen the disaster coming. Well, judge for yourself after you hear the story of Paul Bishop, who worked at the nation's second largest savings and loan. World Savings of California was among the industry's most admired mortgage lenders. But Bishop says the kind of lending practices he saw were leading to a world of trouble that would ultimately result in billions in losses and a federal investigation. What does Paul Bishop say he told executives at World Savings 3 years before the crash?
We're breaking the law. Okay? We're breaking the law. You know we're breaking the law. I know we're breaking the law. What the hell do you think is going on here? You know, you're granting too many people loans who simply can't qualify.
Paul Bishop's story is a rare inside look at forces that tore the economy apart, as seen by a plain-spoken loan salesman who is now suing World Savings, claiming that he was fired for telling executives what they didn't want to hear.
I definitely talked to him about Enron. I said, we're sitting on an Enron. This is bigger than Enron. I mean, if these, we're doing $4 billion a month in loans. If housing drops, housing value drops, people start to default, you know, this is a nightmare. These people will not survive it.
Bishop was a mortgage salesman at World Savings in San Francisco. He'd been a top salesman at IBM and spent years as a stockbroker. And most everywhere he went, he had a reputation for speaking his mind and ruffling feathers. In 2002, he joined World in part because of its history.
Who were the owners?
It was Herb and Marion Sandler.
And their reputation at that time was what?
It's flawless, as near as I could tell.
In fact, Herb and Marion Sandler were legendary. In 1963, they started Golden West Financial and grew to 285 branches under the name World Savings. The Sandlers were known for careful, conservative lending. They've given away millions of dollars to charity and started an advocacy group for low-income borrowers called the Center for Responsible Lending. In 2006, just before the housing crash, the Sandlers sold their bank to Wachovia and pocketed $2.3 billion. Trouble is, some of their money came from people like Betty Towns, who is financially ruined after being sold a series of World Savings mortgages she couldn't afford. Mavelise Brown is a lawyer for a nonprofit group working to save homeowners from foreclosure.
How many times did you refinance?
Well, we refinance practically every year.
World salesman convinced Betty to refinance her mortgage 4 times in 4 years. She got about $20,000 each time.
Well, all I know that they told me this loan was best for me.
But how could it be best when Betty's pension couldn't qualify her for the loans?
But they told me that they would go by my husband's payroll.
even though he'd been laid off from the shipyard.
No, he passed away.
Her husband, Ronnie Towns, was dead. World Savings noted that in her papers, but his former income was used to qualify Betty.
What's Betty's actual income?
About $1,875 now,
What was written on her loan applications?
over
Who
$4,000.
did that?
The interviewer that's listed as a staff person for World Savings according to the loan documents.
What does that tell you?
Looks like whoever typed up this document put in the number that they thought was the right number to get the loan approved.
The term was packaged. It had to be packaged correctly when it got to the underwriter.
Bishop says a story like Betty's was common here at his former office. He says facts were manipulated on some loan documents to get past company underwriters who approved the loans.
Let's not say this, let's delete these items that they're probably not going to check on, let's add this, let's just move it around.
Packaging the loan meant modifying
Modifying.
to make sure it would pass the underwriter's inspection.
Correct. It was one grand wink wink nod nod.
One person you won't see in this story is Herb Sandler. For months we invited him for an interview, but instead he sent a letter. He says it is categorically false to suggest that we trained or permitted employees to falsify a borrower's income. Sandler called it, quote, totally unacceptable in our culture. But Paul Bishop says he watched the bank, famous for quality, begin to emphasize quantity. World relied on outside mortgage brokers to bring in 60% of its customers. The more loans approved, the more the brokers and World made in fees.
We would have these instant underwriting events in an office where we would assemble 5 underwriters right there.
How many loans would be covered in a single day?
80, 90, we would keep track of it. 80, 90, 100
In
would
a
be
day?
reviewed. Yeah, oh yeah.
By 2005, 38% of World's clients had subprime credit scores, and customers were shown flyers that told them that their income would not be checked by the bank.
So I don't really need to know what you make. I don't need proof. You tell me you make 200 grand a year? You make 200 grand a year?
No verification.
Not gonna check.
Herb Sandler told us if there was no income verification, the bank still checked credit reports and appraisals. But we spoke to 2 former World salesmen and a former executive who made similar allegations to Bishop's. One said, quote, it was all about volume, quantity over quality. To understand what was happening in the mortgage industry, we went to Bob Simpson, whose company, iMark, investigates failed mortgages.
When one lender dropped standards, another lender felt that they had to do the same.
Simpson says World and other lenders were in a ruinous competition for customers.
There are people inside of every institution that have been screaming for years about these terrible loans. Don't fund these. These are horrible loans. And they were routinely ignored inside of their own institutions. Why?
Why were they ignored?
Because there's no money in common sense. There's no money in stopping a loan. There's only a payday when that loan closes.
The loan World was selling was potentially risky. It's called an option arm, but at World it went by the cheerful name Pick a Payment. This is what the monthly statement looked like. It offered 4 different payment amounts that the homeowner could actually choose from, but the lowest payment didn't even cover the interest on the loan. Deferred interest would add up month after month, leaving the homeowner farther and farther behind.
That's what happened to Betty Towns. World sold her 4 pick-a-payment loans, racking up $40,000 for the bank. Now her full payment is larger than her monthly income.
Hard to think of Betty without a home.
It's horrifying to think of her without a home. It's just, yeah, unacceptable.
And she's not alone. Between 2003 and 2006, the total amount of deferred interest from World borrowers choosing that lowest payment jumped from $21 million to $1.2 billion.
That's the borrower saying to you, I can't make my payment, or I'm not making my payment. Now, that was increasing at $100 million a month.
Bishop says that's when he began complaining to his bosses.
And basically it was characterized as, look, you're a malcontent. I mean, you're not happy here, you don't like it here, you don't like the way we do business here. And I said, you know, it's all true. You know, it's all true. But, you know, you can't continue to do this.
Then in the summer of 2005, Bishop saw this article in which Herb Sandler boasted about the soundness of the bank's loans. Bishop told us he said this to a senior manager.
I think we have crossed the line. And there's no question in my mind that the chairman of the board, the founder of this bank, has no clue what's going on. Or he's indicating that in the press.
Did you use the term predatory lending with him?
Sure I did. Fraud, for sure I used.
And he said what?
He said, well, you know, I'm not aware of that.
After that, Bishop got into a heated argument with a fellow employee, and the bank threatened to fire him. He says it was retaliation for his complaints. So he talked to Tim Wilson, the corporate head of sales, and Bishop says he told Wilson this.
This is somebody's home. This is a home they can't afford. Okay, we are complicit in this. Okay, you're granting too many people loans who simply can't qualify. I mean, he said, I don't have any instance of that. I said, come down to Vicente Street, pull 100 loans, any 100.
Down to your office?
Down to my office. I said, I don't have the ability to do that, or I'd do it. Come down to the office, pull 100 loans, you're going to be stunned at what you see.
Did he do that?
No.
Tim Wilson, the head of sales, wrote this memo about their conversation, saying Bishop could not point to any specific examples of employees or loans that do not conform to company policy. And he noted, random audits are done weekly all over the country. In his letter to us, former bank owner Herb Sandler said there are hundreds of former World employees who would dispute Mr. Bishop's claims and speak to the company's focus on quality lending. He makes a point of saying that his bank kept its loans on its own books rather than selling the risk to Wall Street, which created a strong incentive to ensure that our loans were based on sound underwriting. Still, since the market collapsed, World's portfolio has lost billions.
What, in a managerial sense, failed? Your leaders either knew those loans were terrible or they didn't know, and either answer is bad for World savings.
And when the Sandlers say we didn't know?
Shame on them. They should have.
What went wrong?
Well, we ran out of borrowers. Anybody that could qualify, anybody that could fog a mirror, anybody that could just breathe, you know, and qualify at any level, had basically been refinanced once, twice, 3, sometimes 4 times.
Herb Sandler told us that World approved only about 60% of its applications. He says his high-quality loans wouldn't have failed had the economic crisis not caused housing prices to drop by 50%. It was just before the crash that Sandler announced he was selling World to Wachovia for $25 billion. For Paul Bishop, it was the last straw. He says he told a manager that he planned to warn Wachovia, and days later, he was fired. Bishop says a lawyer told him to think twice before getting in the way of the merger.
Did anyone at World ever specify why you were fired?
To this date, they have not.
Why do you think you were fired?
I think I was right in the middle of $25.5 billion.
Did you call Wachovia?
I did not.
Do you regret not making that call?
I'll always regret it. I'll always regret it.
The losses from the Picket payment portfolio are now estimated at $36 billion. Wachovia was so badly wounded, it was acquired by Wells Fargo with the help of a taxpayer bailout.
We have talked to some former executives of the bank who tell us that they listened to your complaints, they investigated your complaints, and they found that there was nothing to them.
Are they employed today?
No.
Surprise. They lost their job. The bank went bust. They took down the 4th largest bank in the country with them. But there was no problem.
Do loan types matter? They do. They matter a lot.
How did the mortgage industry destroy itself?
No one went to jail. Must be nice.
It's where we came from. And so when we talk about things, an option arm, well, the arm was what? Adjustable rate mortgage part of it, right? What was the option part? That was that pick a payment. Let me choose. What payment did people pick? The lowest one. And the lowest one wasn't even enough to cover the interest. So what you get there is something called negative amortization. Well, if fully amortized means you're paying it all the way down to zero, what do you think negative amortization means? It means the loan balance is increasing month after month. And so that's what was happening. The loan balance was increasing month after month, and then the ARM part would kick in. And what happened? The interest rate went up. So if they weren't even covering the interest that was accruing when it was at that teaser low rate, what happened when the interest rate adjusted up by 2 or 3%? Foreclosure happened. And when foreclosures start, what happens to housing prices in that neighborhood? They go down, right? Because you got foreclosures in the area. And then when those foreclosures happen, it pushes even more people into foreclosure. Or more people, and then all of a sudden, even the people who are paying their mortgage and are on time look at it and they say, well, I owe $300,000 on my house, which is worth $175,000, so what do? They stop paying, and you get even more foreclosure. That's how you get a housing collapse. And it all starts with putting people in mortgages that they simply should not qualify for. Does that make? And I've had people watch that video and say, well, yes, she knew what she was doing. Well, maybe she did, maybe she didn't. But ultimately, who's more at fault? The borrower who's taking the loan out, or the bank who's making a loan that they absolutely know can't be repaid? That it just cannot be repaid. So when we talk about the secondary mortgage market, when we talk about this secondary mortgage market, we have to remind ourselves that, you know, what we're really talking about here is transferring the risk of these mortgages away from the bank that's making them and transferring that risk down the line to somebody else. So let's talk about the difference between the primary mortgage market and the secondary mortgage market. This is in your book on, it's chapter 15, page 426. All right? The primary mortgage market. The primary mortgage market is where loans are made. The secondary mortgage market is where loans are sold. And we're going to talk about both of those and the functions of them. The first thing they introduce us to is the Federal Reserve System. The Federal Reserve System, which is what Sylvester asked about earlier, is the place, it's the government's banking entity. It's basically the underlying banking structure of the United States. And the Federal Reserve sets that discount rate, which impacts what lenders charge for consumer loans all the way along the line. So why does the Federal Reserve exist? Sometimes they need to raise rates because there's too much money flowing through the economy. That sounds like it would be a problem. There's another word for that when there's too much money flowing through the economy. What do we call that? Anybody want to guess? Inflation. Inflation is when the value of money is declining because it takes increasingly more money to purchase the same thing. If a loaf of bread is $3 today and $4 tomorrow, that's an example of inflation, because the bread itself didn't magically become more valuable. I mean, it's worth the same thing in a real sense as it was worth the day before. You can make 10 sandwiches out of the loaf of bread and you can make 10 sandwiches tomorrow. But if it takes more money, what changed was not the value of the bread. What changed was the value of the money used to purchase the bread. So the Federal Reserve is there to prevent that sort of runaway inflation. One of the responses to inflation is to raise interest rates, because how do you pump less money through the economy? You make money more expensive. Guess what the Federal Reserve just did last week? Raised interest rates. We are in an inflationary period right now. It's not always all good when the stock market goes crazy, because what that creates eventually is inflationary trends. So to tamp that down, and guess what raising those interest rates will inevitably lead to? Less spending, which is exactly the goal. So we always want people to spend, 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 but when we start to see inflation, the Federal Reserve will step in and raise those interest rates up, because it slows that flow of money through the economy so it does not become overheated, presumably. And this is the first time in years and years and years that they've actually stepped in to raise interest rates. Anybody want to know what the discount rate has been? It's not right now, but what it has been for probably most of the last decade since the financial collapse?
Zero.
Zero. That's what the discount rate has been for almost a decade now, zero. And it's just now up to about 0.75%. So when you get it to zero, there's not much you can do. And why would you drop it all the way down to zero? If raising interest rates has the effect of slowing money moving through the economy, what does dropping interest rates hopefully do? It speeds it up. It allows more movement of money. You try to do that when you're trying to recover from something like a housing collapse. All right? So that's the Federal Reserve System, and that's about all you need to know about it, really. And that's just a map of the different Federal Reserve banks, if you were ever curious about what areas they cover. All right, so get past this. There's way more information than you need on the Federal Reserve System. The Treasury works hand in hand with the Federal Reserve System to move money through our financial systems in this country. They also supervise the FDIC. Remember we talked about FDIC, Federal Deposit Insurance Corporation, because that's a big deal when you're making deposits at banks. Remember, that's one of the reasons we require trust accounts to be in banks, because banks have what kind of insurance? FDIC insurance, and that's supervised by the U.S. Treasury. So let's talk about the primary mortgage market. The primary mortgage market is where loans are made. Loan originators are in the primary mortgage market. So this is where the consumer borrows the money. So give me examples of some places where a consumer might go to borrow this money. A bank. Where else? A credit union. Where else? A mortgage broker. And mortgage brokers come in all shapes and sizes. Like, could you go online and find a mortgage broker? Like Rocket Mortgage or Quicken Loans or one of those outfits. You could get a mortgage broker through there. Are there mortgage brokers who have offices all over the place? So let's talk about the difference between a mortgage banker and a mortgage broker real quickly here. A mortgage banker works directly for the funding institution. So a mortgage banker would be the person you would go see in a Wells Fargo branch or a Bank of America branch. Because whose money are they lending you? Their bank's money. Whereas a mortgage broker could potentially lend you money from a wide variety, any bank. And not just banks, because banks are not the only sources of money in the primary market. But when you go to a broker, they're going to be able to shop around and find money from many different sources. So a much wider variety of funding sources for a mortgage broker. How do you think they get paid? Mortgage bankers are usually paid a salary by their employing bank. How would a mortgage broker get paid?
Commission.
Commission. So let me ask you this obvious question. If they're paid based on commission, think about us being paid based on commission in a sale. What impacts our commission? The number. What number? The purchase price, right? The higher the purchase price, what happens to our pay? It goes up. You think the same would be true on a mortgage loan? Mm-hmm. So the higher the loan amount, the more they're making. Wonder if I got a higher interest rate for that lender on that loan, would they pay me a higher commission? Gosh, it couldn't be that ugly, could it? So that friendly mortgage broker that's sitting across the table from you, you think it may be possible that they're not presenting you with the best possible interest rate? That maybe they're selling up that interest rate because they know if they take, let's say they're lending Wells Fargo's money. Now Wells Fargo says, well, you can make that loan at 4%, and then they come back to Wells Fargo and said, I made it at 4 1/8. You think they're going to get paid a higher commission for making that loan at 4 1/8 versus 4? You better believe they are. You better believe. That's why everything is negotiable. That's why you should always shop around those rates. It's amazing to me how many times when you have clients in this business and they'll go to a mortgage broker and they'll get a fee worksheet back and they'll say, this is the loan we can do for you. And then you send that client over to talk to 2 more mortgage brokers and they get different numbers from those 2. And then they call the first one back and say, well, I'm going to go with option C because here are their fees. And option 1 says, well, send me a copy of that. Let me see what I can do with it. And inevitably they come out with a better number than they started with. Do you think they engaged in some negotiation with Bank of America on the back end, or were they just robbing you in the first place? Which one is it? Always shop it around. Always shop it around. And encourage your clients to shop it around when they're going through the mortgage lending process, because there's all kinds of fees that can be negotiated and are built into the pricing structure of those loans. So when we talk about the primary mortgage market, how do these people make their money? How do you make money if you're in the primary mortgage market, the consumer part of it? What kind of fees? Origination fees, a perfect example of how a primary lender would make money. What else? Interest over the life of the loan. That's how a primary lender would also make their money. So there's lots of sources for where money could come from in the primary mortgage market. You know, for example, insurance companies. Those of you that remember the meltdown, the mortgage meltdown, one of the most shocking things that came out of it was that the largest insurance company in the world very nearly failed. And everybody said, why? Why would AIG, the largest insurance company in the world, be literally about to fail because mortgages are failing? What had AIG invested all their money in? Mortgages. AIG was taking all those premiums that were being paid in on life insurance policies, health insurance policies, property and casualty policies, and they were lending that money out as what? As mortgages. And that's how you get a lot of the funding sources are not just necessarily banks, they're insurance companies, they're credit unions, they're 401k plans. Mortgages touch every aspect of our financial society. Pension funds, big sources of mortgage lending. And why has that traditionally been fine? Why is that seen as fine? Because mortgages have always been viewed as what? Safe, secure. Mortgages were always viewed as very safe lending. So these places that had large sums of money, it was one of the best places they could invest their money to grow that pension fund. Endowment funds like universities. Many universities lost their entire endowments when the mortgage meltdown happened because they had taken money that had been donated to them and had invested it in the mortgage market to be loaned out because it was getting safe returns, or what they thought were safe returns. Investment groups. These are all just examples of sourcing. You don't need to memorize any of these. All right? We do need to talk about the secondary mortgage market, though. This is where loans are sold. And this is on page 429 in your textbook. Where loans are sold. What do you think the primary reason we have a secondary mortgage market is? Why do banks want to sell these loans?
So they can lend more money.
So they can lend more money. So if you had to answer a test question about what is the main reason for the secondary mortgage market, what would you say? That's what happens there, but what's the main reason for it? To make more loans, to get more money back into the primary lending system so that more people can have access to those loans. Because ultimately, the more loans that are made, the more fees are generated, the more profit is generated for everybody, both in the primary system and in the secondary system. Does that make sense for you guys? So the purpose of the secondary system is to pump more money back into the primary system. We said the primary system is where what's happening? Where consumers are getting loans. That is Faith walking into Bank of America and borrowing money. That's a primary lending function. Or Nick going on Quicken Loans website and putting in a mortgage application. That's a primary lending function. Secondary lending function is when they package that loan up after it's been made and they sell it to an investor or a group of investors. Folks, that happens almost instantaneously in most mortgages now. It is very common, and you'll see this as you get into the business, it's very common to go to a closing, especially with one of the big banks like Bank of America or Wells Fargo. If they're funding the loan, one of the big banks, it is very common to sit down and see this much paper over there that borrower's got to sign. And they just start signing documents and signing documents. And then, so it's all of Bank of America's lending documents. And then you get halfway through the pile and you see a document that says assignment of mortgage. You know what's literally already happened before you left the closing table?
They've sold the loan.
They've sold the loan. Literally, before you walked out of the room, you don't owe the money to Bank of America anymore. You owe it to, Mortgage Processing Systems, who's an investor who buys a bunch of mortgages. It happens that quickly in many cases. And then could Mortgage Processing Systems package it up and resell it to somebody else? Sure they could. Sure they could. It is very fast. Yes?
Do they tell you?
They do tell you. They tell
They
you.
tell you who
They
they
just don't
sell
ask
to?
for permission.
They do tell you who they sell it to. They just don't ask your permission.
Also, then in the future, you just pay whoever owns it, right?
Not necessarily, because very often what would happen is that Bank of America would sell the loan to Mortgage Processing Systems. And Mortgage Processing Systems is interested in buying the loan, but they're not interested in collecting on the loan. They may not have a system in place to collect those monthly mortgage payments. So they may tell Bank of America, we'll buy the note from you, but we want you to service the note for us. Meaning, you continue to collect what? The mortgage payment, and you just send us the money. But are you going to send us all the money, or is Bank of America going to get a little taste out of that?
Oh, they're going to get the servicing.
They're going to get a servicing fee. So they probably would. That's another way that Bank of America makes. The more loans they can make, the more fees they can generate, because they know when they sell that loan in the secondary market, they're probably going to continue servicing that loan, because they offer that as a service. When you come to them and you say, well, we want to buy this $20 million worth of mortgages from you, they say, yeah, we'll be glad to sell it to you. And we'll be glad to service it for you for 1% of the monthly amount that's paid in. So if you're sending in $1,000 to your mortgage payment, then Bank of America is keeping $10 of that just for collecting the payment on a monthly basis. I'm sorry?
Who pays that?
What do you mean who pays it?
That you say $10 service fee, who pays that?
Well, it's taken out of the mortgage. So when Bank of America collects the $1,000 and it's already been, and the mortgage has been sold to somebody else, they're not sending $1,000 to that somebody else, they're sending them $990.
But you won't even know, right?
You won't know.
Um,
Absolutely not. You continue to make your payment to the same place. You'll get a letter in the mail that says you now owe the money to somebody else, but you'll continue making your payments to us as a convenience to you. Of course it's a convenience, right? So Bank of America can generate the fees. That's called a servicing charge. It's a big source of income for the big banks. And the reason for that, and could the investor buy it and service it themselves?
Yeah.
Of course. They don't want to do that because they don't have a relationship with you. They look at it this way. Bank of America already knows who you are. They already have all your information on file. They already have set up probably for direct deposit, direct draft payments from you. They're locked in. Why upset that apple cart? We'll just pay them the $10 a month rather than us have to set that system up ourselves. That's the reason that they allow SunTrust or Bank of America or Wells Fargo or whomever to continue servicing that loan. Okay? Let's talk about Fannie Mae. Fannie Mae, and this is in your book on page 429 going into page 430. So this is where we have to have a little bit of story time. Because I feel like if I don't, granted I'm taking some license here, I'm just going to tell you this is not precisely the whole way things work. But it is the best attempt I can make at helping you understand how the secondary mortgage market functions, okay? So, go back to the Great Depression. When the stock market collapsed in 1929, basically the flow of money in this country shut down, completely shut down. You could not borrow money for anything, and the reason you couldn't borrow money for anything is the banks didn't have what? Money to lend. Banks failed left, right, and center. People had runs on the bank because you thought, if you got up this morning and somebody told you your bank is about to go out of business and run out of money, what would be the first thing you would do? You'd run to the bank, and those are called runs on the bank. Well, there was no FDIC insurance back then, so when everybody showed up at once that wanted all their money, did the bank have any money to give them? No, because usually what had banks done with the money that had been deposited to them? They had loaned it out to people. So the banks failed. There's nowhere to borrow money. If you can't borrow money, can you purchase property in many cases? What does that do to property values? They decrease dramatically. And that's an ugly cycle that continues to repeat itself. That led to the Great Depression. The Great Depression took many, many years to recover from. And a lot of lessons came out of that. One of the lessons was that the biggest hindrance to a recovery was that banks didn't have money to lend. Is everybody with me so far? So, the federal government created a system to allow banks to borrow money from the one place that presumably would never run out of it because they print it. Where could these banks borrow money from? The federal government. And actually, they didn't create a system to borrow money directly, for the banks to borrow money directly from the federal government. They created a company. The federal government created a company. And we traditionally think of companies being created by who? Like private citizens, right? Because companies are for-profit businesses. Well, Fannie Mae is a for-profit business. The Federal National Mortgage Association, FNMA, that's why we call it Fannie Mae. Fannie Mae is just a cutesy abbreviation, or a cutesy way of pronouncing the abbreviation, FNMA, the Federal National Mortgage Association. Fannie Mae was created by the federal government as a private company who had one job: buy mortgages. Fannie Mae would buy mortgages from banks because if banks could sell mortgages, what did they now have more money to do? To lend out. So if the bank could make a mortgage and then turn around and sell it to Fannie Mae, then they had their money back so that they could lend it out again. Does that make sense for everybody? Now, Fannie Mae was created as a for-profit company. But it had the ability, and still does, to borrow money directly from the federal government. So when people weren't investing in Fannie, how do companies make money? So how is Fannie Mae going to make money? It's a for-profit company. How are they going to make money? If you buy mortgages, how do you plan to make money? Interest. Does that make sense for everybody? And so how did Fannie Mae raise money? Well, they raised it by selling stock. It was a private company. And if you thought you could make money by buying stock in Fannie Mae because they owned a bunch of mortgages, that's what you did. Well, the special thing about Fannie Mae was that even when they couldn't raise money the normal way, in other words, nobody was buying their stock, they didn't have enough money flowing in, Fannie Mae could borrow money directly from the federal government. What does that do to the flow of money going into mortgages when you essentially say, here, Fabian, you buy mortgages, that's your job. And if you run out of money, you come to me and I'll give you some more. What does that do to the mortgage market at that time? Does it help stabilize it? Because there's an uninterrupted flow of what? Money. That even if Fabian doesn't have enough of his own money, he can do what? Borrow money from the government, who never runs out. Now, borrow means you have to repay, correct? But the idea was that Fannie Mae should never run out of money. Are you with me so far? That was the first step to our current mortgage system. Now, keep in mind, the goal of Fannie Mae was to do what? But keep going. It was a private company. Its main underlying goal, why do you have private companies? To make money. So, the only way Fannie Mae could make money long term is if they bought good mortgages that people actually paid on. Does that make sense? The only way that Fannie Mae could generate enough funds to continue to operate and continue to buy mortgages and pay back any money they borrowed from the federal government is if the loans they bought were safe loans. Are you with me so far? And that's exactly what they bought. Safe loans. Very safe loans. We're going to talk about them in a minute. They're called conventional loans. The idea of a conventional loan. A conventional loan, conventional means safe, right? If you do things the conventional way, you do things the safe way. You're not out there on a limb somewhere. You just kind of go along to get along. That's the conventional way. So what kinds of things would make a loan safe from a lender/investor's perspective? If you were looking at buying loans from a bank, what would you look at and say, that's the loan I want to buy?
Credit score and income.
So you look at the borrower, right? Yeah. You'd look at the borrower and you'd want well-qualified borrowers. Does that make sense? Mm-hmm. So I would look at credit history. We probably didn't have a credit score in 1945, but credit history was something that existed. You'd want good credit history, right? Would you want them to have a good level of income? What else would you want them to have? Again, what's the worst case scenario in a mortgage from a bank's perspective? They don't pay, and that leads to what? Foreclosure. And so if you went there, you'd want to make sure that you could sell that property and do what? Get your money back. So what's the third thing you would look at that would make a borrower? Down payment, equity. You wanted borrowers who had equity. So the idea of a conventional loan was these were your best qualified borrowers and they were making big down payments. Does that make sense for everybody? And traditionally that number was 20% down. That was the number everybody wanted to see. You needed to have a 20% down payment. Because at that point you were safe. The lender viewed you as safe. Does that make sense? And here's what changed. Prior to this, because loans stayed on the books of the bank making the loan, who was making the decision about lending?
The bank.
The bank. Because it was my money and my risk. Does that make sense for everybody? If the loan failed, it was on my head because it was our bank's money. If I'm selling the loan to Fannie Mae, do I care what the risk is? So who now starts to set the principles of lending? Is it the actual banks themselves?
No.
Or is it Fannie Mae who's going to be buying the loans on the back end? Does everybody follow that? It's Fannie Mae. Because what happened is that the lenders simply said, don't care what the borrower looks like. All we care is that we can do what with this loan? Is that we can sell it. So the lenders started to essentially look to Fannie Mae and say, what kind of loan would you like to buy? What would you like to buy? Because that's what we want to make. That's the loan I want to make as a bank. I don't want to look at faith. I don't care about faith. I care that I can sell Faith's loan. All I care about is that when Fannie Mae looks at this loan, they go, yes, I'll buy that. Does that make sense? So when Faith walks into the bank and she fills out an application, where am I going to send that application to? To somebody at Fannie Mae and say, if I give this person a loan, will you buy it? That's the conversation that happens. So I hear people all the time say, oh, I didn't qualify for a loan at Bank of America, I'm going to SunTrust. Well, good luck. Guess what? You ain't going to qualify there either. And you're not going to qualify at Fifth Third, and you're not going to qualify at State Employees Credit Union, you're not going to qualify with a mortgage broker. You know why? Because they're all calling Fannie Mae. That application's literally being looked at, no matter how many different places you go, by the exact same institution. Because ultimately, what is the lender going to do with that loan when they make it? Sell it to Fannie Mae. Does that make sense? Everybody following this so far? The kind of narrative we got going on here? What kind of loans did I say Fannie Mae was buying? Conventional, which are what are they? Good loans, bad loans, high quality, low quality? Safe, high quality, good, well qualified borrowers making big down payments. That's why people were willing to invest their retirement funds in Fannie Mae. Because Fannie Mae only bought the cream of the crop. Is everybody with me so far? The federal government stepped in again and said, this is working well, but there are people who we would like to see have mortgage loans that are not getting mortgage loans. After the end of World War II in particular, the GI Bill was passed, and a particular type of loan was created called the VA mortgage, the Veterans Administration Mortgage. Who was this loan obviously targeted at? Veterans, particularly ones returning from World War II. Here was the catch about VA loans. The idea was that these people had not had an opportunity to build up a down payment because they had been in Europe or in Asia fighting. So we wanted to reward them for their service to the country by offering them loans where they didn't have to do what? Make a down payment. So the federal government created this idea of the VA loan. The problem became they couldn't find any banks who were willing to actually fund these loans. Because it's not the government lending the money. It was the government creating the loan program and then saying to banks of the time, here, we'd like you to make this loan. This is going to help our veterans. What does the bank say to that? I like veterans and all, but I'm only making loans if I can sell them. I like this whole Fannie Mae thing. It's working well for me. Because I can make a loan and do what? Sell it and get some fees and turn around and do what? Do it again. Does that sound much better to you if you're the bank? And the government said, well, no, you really need to make these loans. And the bank said, no, we really don't. So the only way the government could convince lenders to make those VA loans was to convince Fannie to do what with them? To buy them. But again, Fannie only bought the cream of the crop. What made you a well-qualified borrower? What was one of the criteria for being a real qualified borrower? You, not only credit history and income, but you had a what?
Down payment.
A down payment. The VA loan doesn't require a down payment. So, enter Ginnie Mae, the Government National Mortgage Association. Ginnie Mae has one job: buy the crap that Fannie Mae won't buy. Now, you can't make money buying crap. It's impossible. Do you agree with that? There is no money to be made buying crap. So Ginnie Mae is not a private company. Ginnie Mae is the United States federal government. Because the only way we could incentivize Fannie Mae to buy these loans was not to have Fannie Mae buy them, was to have somebody else buy them. That somebody else is called Ginnie Mae. So Ginnie Mae was created expressly to buy crappy loans. Now, we're not saying that they're crappy borrowers. We're just saying from the standpoint of security, are these much worse loans than conventional loans?
Yes.
Because the borrower doesn't have a down payment. They don't have any equity in the property. Is everybody following me so far on this? Guess what Ginnie Mae's going to do with that loan once it gets it? It's going to buy the loan. So now will the bank make the loan? Once Ginnie Mae steps in and says, oh, we'll buy that. And they're buying it with money from where?
Federal.
The federal government. Well, the federal government does not want to own mortgages long term. They don't. So they want to sell this thing. Just like the bank wanted to sell it, they want to sell it. Are they going to run into the same problem trying to sell it?
Yes.
Uh-huh. How do you convince somebody to buy something they don't think is any good? Put a guarantee on it. How does somebody convince you to buy a car? We'll give you a warranty. Ginnie Mae said, we will sell you this loan and we will guarantee it. We will guarantee that if that borrower defaults, we will make you whole. Does that loan become much more interesting to Fannie Mae now all of a sudden? Because it is backed by the full faith and credit of the United States federal government at that point in time. Could that loan now be sold to Fannie Mae? Yes. And that's exactly what happens. So what's going to happen with that VA loan? Bank of America makes it and is instantly sold where? Ginnie Mae. Ginnie Mae instantly places a guarantee on it and sells it to Fannie Mae. And if that borrower defaults, Fannie Mae is going to look to one place and say, make me whole. And where's that one place? The United States federal government. So, what it actually means when we talk about something like a VA loan is that the government's not making that loan. What are they doing? They're guaranteeing that loan. It's a private loan. It's being made, bought, and sold through the normal channels, but now it has a guarantee placed on it by the United States federal government. So therefore, is it much less risky?
Yes.
At that point in time, would Fannie Mae rather maybe even have that than a conventional loan? Because the conventional loan still has a chance of failing, correct? I mean, it's a low chance, granted, but there's a chance. What's the chance of losing on that VA loan from Fannie Mae's perspective? Zero. Can you get a VA loan now? Will Bank of America make a VA loan if they know they can sell it instantly? And will Fannie Mae buy it instantly if they know it's guaranteed by the United States federal government? Yes. That is our current. Does the story help? Does it help give some perspective about how these things flow through? Now, I've taken some dramatic license there a little bit, but that's basically how the system works. Ginnie Mae's job is just to buy these risky mortgages. Can you think of other types of risky mortgages which don't require much of a down payment? What's the other big government-backed loan program? Not first-time home buyers, but it does start with an F. FHA loans. FHA loans are very much the same process. They are not made by the federal government, but they are what? They're guaranteed. So who's going to buy them after SunTrust makes you an FHA loan? Who's going to buy that from SunTrust? Ginnie Mae, and then they're going to guarantee it, and then they're going to sell it to Fannie Mae. You notice a trend here? Who ends up with all the loans? Fannie Mae. Their current loan portfolio is a little over $20 trillion. $20 trillion. A trillion is 1,000 billion, and a billion is 1,000 million. That is a lot of loans. That is a lot of loans. I'm sorry?
What is FHA?
What is FHA? We're going to talk about it. FHA is a loan program which requires low down payments and targets troubled borrowers, borrowers who have trouble ordinarily qualifying for conventional mortgages. So they have lower down payments, they have lower credit score requirements, lower income requirements than conventional loans do. So if you say, that's the trifecta, right? You can get an FHA loan with worse credit, lower income, and a lower down payment. What has that done to the risk factor of that loan defaulting? It has sent it through the roof as compared to a conventional loan, right? I mean, if you're the bank and you're looking at two borrowers, well, here's one, they got 20% to put down, they got a 780 credit score, and they make $100,000 a year. Here's borrower number two, they got $2,000 to put down, they've got a 620 credit score, and they make $40,000 a year. Which borrower do you prefer if you're the bank? Actually, you don't care. Because what are you going to do with both of those loans? You're going to sell them, because you're going to call Fabian at FHA, you're going to say, which one will you buy? And what's his answer going to be? Both. They'll buy the conventional one directly, and they'll buy the junky one through Ginnie Mae. And so which one do you approve? Both. And if you're the bank, here's a real ugly secret. You'd probably rather make loan number two. Because generally speaking, if you have worse qualified people, what can you do with them as far as fees and all those kinds of things done? You charge them more. They're desperate. That conventional buyer, that conventional borrower, they can go to any one of 100 places and get a loan. You got to compete like hell for them, right? How many options does that 620 credit score with a $2,000 down payment have? Very limited. You gonna charge them more fees? So the ugly truth is banks actually like to make those loans because they're passing the risk off. They're passing it off.
Will that be a problem in the future? It sounds like a problem.
Was it a problem in the past?
Yeah.
So is it going to be a problem in the future?
It's different way of pattern, you know. It's still going to create the same problem.
It will create the same problem. Absolutely. Ultimately, there is only one way to prevent risk when you're lending. We said it on Tuesday. Don't lend so much money, right? As long as we can, and I'm not knocking high loan-to-value loans. I'm just pointing out you should understand the risk involved with them because that will help you on the test. The higher that loan-to-value ratio goes, the more risky the loan is by definition. Because the worse collateral you have, right? When you're lending a higher percentage of the value of the property, there's a higher chance that if you have to foreclose, you can't get your money out of it. That ramps the risk up substantially. And that's where we start talking about things like mortgage insurance, which we're going to talk about. And what is mortgage insurance and why does it exist? Well, it exists to set aside some of that risk that's involved with those high loan-to-value loans. All right? So, we talked about Fannie Mae, and we talked about Ginnie Mae as well. I will just barely mention Freddie Mac, largely because it doesn't exist any longer. Freddie Mac was created to do what Ginnie Mae does, but to buy loans specifically from credit unions and savings and loans. During the financial collapse, loans made by credit unions and savings and loans failed at a rate of about 10 times faster than other loans. So Freddie Mac's portfolio did not do very well during the financial collapse, and the federal government took it over into conservatorship, which is where it still remains. So it is part and parcel of the federal government at this point in time. All right. We talked about the financial collapse. And now we have gotten to the point where we introduce a difference between conventional loans and government-backed loans. This is over on page 432 in chapter 15. So the conventional loan. What do we say is going to be the primary characteristic of a conventional loan? I'm sorry? Big down payment and highly qualified what? Borrowers. Big down payment, highly qualified borrowers. Now, conventional loans can come in either insured or non-insured. Also conforming and non-conforming. Let me talk about conforming and non-conforming because that's the easier one. Fannie Mae will only buy loans of a certain size. Fannie Mae has a cap on loans, loan amounts. And that cap is different for every zip code because the cost of housing is different in every zip code. Does that make sense? That, you know, obviously the average cost of a house in Raleigh is going to be different than San Francisco. So Fannie Mae has a schedule of where their cutoff is based on where the property is located, of how big of a loan they will buy. The banks call a loan that Fannie will buy a conforming loan. Anything above that they call non-conforming, but we actually normally hear it as something else. How many of you have ever heard of a jumbo loan or heard that terminology? A jumbo loan is simply one that's bigger than Fannie Mae will buy. The loan amount is too high, Fannie Mae will not buy it. So, if the bank can't sell it to Fannie, is that going to probably make that a harder loan to qualify for? Yes. Therefore, it's going to have a higher interest rate usually, since they have to work harder to get rid of it or they have to keep it in their own portfolio. That's why jumbo loan rates are higher than conforming loan rates. Almost always higher. We could also have insured or uninsured conventional mortgage loans. So I can probably show you this better than I can explain it here. So when we talk about a conventional loan, or really any loan, but we'll start with a conventional loan. Think of the value of the property sort of like a little bucket, right? So we've got our bucket here. Traditionally speaking, a lender was willing to lend 80% of the value of the property, so 80% loan to value. And they felt pretty good about that because, again, what's the worst case that could happen with a mortgage? Foreclose. They don't pay, they default, so you have to foreclose. And if the worst happened, they felt pretty good about that because they felt good that if they had to foreclose and you'd only borrowed this amount, they were going to get what? They were going to get their money back. Does that make sense? So we have this sort of line in the sand here at 80% loan to value. Anything lower than that is going to be uninsured. So anything under 80% loan to value is going to be uninsured. So if I'm only borrowing 75% loan to value, am I going to need any type of mortgage insurance?
No.
Not homeowners insurance. It's very different. Mortgage insurance. What do you think mortgage insurance is? It's insurance against the mortgage doing what?
Defaulting.
Defaulting, right? So who would mortgage insurance benefit?
The lender.
The lender, because it's insurance that the borrower won't default. Does that make sense? And so traditionally speaking, if you got a conventional loan and you only borrowed 80% loan to value, you didn't need mortgage insurance because you weren't seen as a high risk. Let's say we borrow 90% loan to value. Are we higher risk at that point in time?
Yeah.
Borrowing more money.
Borrowing more money. Less collateral, right? Less equity equals less collateral. Higher chance that if the bank has to foreclose, they won't be able to do what? To get their money back. When we get above that line and we get here, this is going to be insured. How many of you have ever heard of PMI, or private mortgage insurance? Now, who does mortgage insurance benefit?
The lender.
The lender. Benefits the lender. Who's going to have to pay for it?
Borrower.
The borrower is. This is insurance that you won't default. So I'm getting a conventional loan and I'm borrowing more than 80% loan to value. They're going to force me to buy insurance. Now, is the insurance going to cover the default for the whole loan amount? Is the whole amount covered? No, because that amount below 80% is always what? Uninsured. So I'm only buying insurance on the amount I borrow above 80% loan to value. Does that make sense? And for the record, it could even be up here. You might see a conventional loan at 95% loan to value. We're going to need mortgage insurance up there? Is it going to be more expensive than the 90% loan to value mortgage insurance? Is it going to get exponentially more expensive as we get closer and closer to the top of that bucket? Yes, because what happens to the risk as you get closer and closer to the top of that bucket? It increases, and it increases dramatically. Would you agree that a borrower who borrows 95% loan to value is probably 100 times more likely to default than somebody who only borrows 80% loan to value? Because if you put 20% down, you've got major skin in the game. You do not want to be foreclosed on. You pulled $40,000 out of your pocket. You don't want to be foreclosed on. But if you pulled $5,000 out of your pocket, are you much more likely to just say the hell with it and walk away? Lot more risk. So that mortgage insurance, the cost of it's going to be dictated by how far up that chain you go. This is called PMI, private mortgage insurance.
And 80% is always that standard?
80% is the gold standard. 80% is the gold standard. So if you're putting 20% down or you're borrowing 80% or less, you're not going to have mortgage insurance. If you go above that, there's going to be mortgage insurance. And so here's what you need to understand. PMI is on conventional loans. So if I tell you you've got PMI, private mortgage insurance on a loan, what does that tell you about the loan? Number one, it's what? It's conventional. And number two, how much have you borrowed? More than 80% loan to value. Does that make sense? Does everybody follow those two conclusions? If I say you have PMI on a loan, then you borrowed more than 80% and you got a conventional loan. Is everybody good with this? Coincidentally, this is exactly what the government-backed loan programs look like as well. But we just don't call it PMI. It's not private mortgage insurance, it's government mortgage insurance. See, when you get an FHA loan or a VA loan, you're buying mortgage insurance. You're just buying it from who? The federal government. Now, I say the federal government was backing those things up. I never said they were doing it for free. You want to know what the biggest profit center line is for the United States federal government? It's about the only thing they actually make money on. The government mortgage insurance programs. Because every month, if you have an FHA mortgage, when you make your mortgage payment, guess where some of that money's going? To the government mortgage insurance program, to the federal government. It is an insurance program. You pay premiums into it just like you would private mortgage insurance. It's not a charity. The reason it's done through the government is because it would be very hard to find private groups that would be willing to take on that level of risk. Because there's tremendous risk there. Because usually what happens is what we saw in the mortgage meltdown. When it goes bad, it all goes bad at one time. Private companies can't withstand that sort of risk. Does this help? Understand this idea here? So, uninsured would be 80% or lower. Anything above 80% loan to value. Now, with conventional loans, usually they're structured so that once you've paid it down to a certain amount, the mortgage insurance would fall off. So if you go out and you take out a 90% conventional loan, are you going to have private mortgage insurance to begin with? Yes. Usually it's structured so that when you get to a certain percent equity, the mortgage insurance would fall away. You would lose that mortgage insurance premium. It's not going to be 80%. It's usually more like 75%. They give themselves some buffer room there. But it will fall away at a certain point in time. Government-backed mortgage insurance never goes away. You take out an FHA loan and you keep it for 28 years and you're still paying mortgage insurance. All right? It never goes away. It used to, but not anymore. Everybody understand the insured versus uninsured now? Okay, and what did we say conforming meant? That it was what? Fannie would buy it because what?
It's under a certain.
It's under their top amount. To give you an example, in Wake County, the conforming amount is $417,000. So Fannie Mae will buy any mortgage loan in Wake County that's $417,000 or less. So that means if you got a jumbo loan, you're borrowing more than $417,000. Jumbo loans are pretty rare. Very few people get a jumbo loan. Even if I'm buying a $600,000 house and I'm borrowing $500,000, I'm probably not going to get a jumbo loan. I'm probably going to get one loan that magically happens to be $417,000 because they're going to do what with that one? Sell it to Fannie, and then I get a second mortgage for the difference. You usually do everything you can to avoid a jumbo loan because the rates are significantly higher than they are on conforming loans. Make sense? Because usually the rate's going to be tied directly to what? Risk. The more risky, the higher the rate. And why would a jumbo loan be more risky? Because they can't sell it to who? They can't sell it to Fannie. They can't transfer the risk. They're taking on more risk because they can't sell it.
So that jumbo is going to be with primary.
They're going to probably keep it on their books? Yes, most likely. So Faith's question was that jumbo, if you got a jumbo, it's probably going to be kept on the bank's books, and the answer is yes. Or it'll be sold to some investor other than Fannie Mae, and since that investor's buying riskier loans, they're going to want a higher return, so you're going to get a higher interest rate. Okay? So usually you do everything you can to kind of stay out of those jumbo rates. They're structured as two separate loans. And of course the smaller second one's going to be at a higher rate, but you'd rather have that small amount be at a higher rate than the whole big loan be at a higher rate. Home equity lines, HELOCs. These are loans done outside of purchase. These are loans done after you already own the home. You are borrowing against the, what is that word? The equity you have in the property. So if at some point in time you need more cash and you have equity in the property, you can open a home equity line. These are very useful. But as a real estate broker, folks, they are the devil. Goodness. Because they complicate our job so dramatically. Here's the problem with a home equity line from our perspective. They're open-ended. How many of you have ever opened a home equity line or ever investigated one? So a home equity line is not like a mortgage. With a mortgage, you borrow a set amount of money. We know how much you owe. Therefore, we know how much your payoff is. Does that make sense? With a home equity line, they usually give you a checkbook. You don't walk out of the bank with any money. You walk out of the bank with a line of credit up to a certain amount. Well, that's very hard to determine how much you actually owe when you get ready to sell your house. If you have an open home equity line and we're trying to sell your house, we don't know if you owe $2,000 or $22,000 on that equity line. It very much complicates the closing process. So if they have home equity lines open and they're already paid off, because a lot of times what happens is somebody opens an equity line and maybe they don't owe anything on it. They've paid it down to zero. Well, the line is still open. It creates a tremendous problem with us for closing because we don't know how much that lien is for. And the closing attorney has a hard time determining how much that lien is for. So just FYI, as advice, has nothing to do with the exam. If you have a client who has an open home equity line and they want to sell their house, close it. Get it closed out because it'll be much more smooth in the closing process not to have that open lien hanging out there.
For that process of the close, they just report that they have paid it down or go ahead.
They have to go to, well, if they have a balance, they have to pay it down. But a lot of times they're still open once you pay them down. They don't go away when you pay them down to zero. You still have, because you could borrow the money again. That's the whole point of a home equity line. You paid it down to zero, but you still have this line of credit, so you could borrow it again. Okay. And that's why it's a problem, because the closing attorney can't determine if you've actually borrowed it again, right? So what if you went out the day before closing and you wrote a $25,000 check on that home equity line and it hasn't had time to hit the bank yet? Is that going to create a lien for the purchaser on that, the person who's buying that property going to end up with a lien against their property? So that's why it creates all kinds of rippling problems. So if you have somebody who's got one of these things open, but at a zero balance, get them to go to the bank and close it. We want that line closed. We don't want it open because it creates questions.
What kind of like interest rates? Like,
For HELOCs, I mean, they're usually not that bad, quite honestly. I mean, they're not terrible. They're higher than mortgage rates are, but not terribly so. Right now, they're running about 6% for a lot of HELOCs, 5 to 6%, whereas mortgage rates are more in the 4.5 range. Yes, ma'am, Sandy.
So this is for people that want to take some money out, like some cash out.
Correct.
Against their property.
Against
like
the equity that they have.
So the property will be like let's say if this house bought in cash,
Okay?
and then let's say it's $300,000.
So then you have $300,000 in equity, because the equity is the difference between what it's worth and what you owe. And if you owe zero, then the equity is the full value.
And then you can take like out $300,000 of this.
Depends on what the bank approves you for as far as an equity line. It's usually some percentage of the value. They usually won't let you do an equity line for 100% of the value, but you may say 90%.
What if you wouldn't pay it back?
What do you mean, what if you can't pay it back? They foreclose just like any other lender. It's a lien against the property.
Oh, so it's like a lien, not like mortgage.
Mortgage and a lien are the same thing.
Is it?
A mortgage is a lien.
Oh, all right. At least it's a different way, so kind of.
It's a different structure, but it's still a lien. Remember, a lien is the right to do what? To foreclose. So when you open a home equity line, you're taking out a lien on your property. So if you don't pay, they foreclose.
The Fannie Mae bought all these mortgages. The bank no longer own your house anymore. How
The bank didn't own your house anyway. You own your house.
Yeah, but then they cannot foreclose anymore, you know what I
Sure,
mean?
the investor, whoever has that note, can foreclose. So who can foreclose?
It's
Fannie Mae.
All right.
Fannie Mae would. Yes.
does the trustee stay with the same trustee, or does it transfer every time?
Generally, it stays with the same trustee. They can assign a new trustee, but generally speaking, it stays with the same one. And the reason is, that's generally a one-time fee, so the trustees usually pay like, $500 to be the trustee, and then but that's forever. So they're the trustee as long as that mortgage is transferred, so it usually stays the same. Did I see somebody else's hand? No? Good? Okay? We already talked about determining loan-to-value ratio, so I'm going to skip over that. Remember, it is just the percentage of the purchase price that you're borrowing. Now, I'm going to add one little wrinkle to that. What if the property does not appraise for the purchase price? Do you think they're still going to lend you that percentage of the purchase price, or are they going to drop it down to a percentage of the appraised value?
The appraised value.
Right. It's going to be whichever's lower. They're going to look at the lower number of either purchase price or appraised value, and they're going to lend based on that number. So if you're getting an 80% loan to value, they'll look at which is lower, the purchase price or the appraised value, and we're going to lend 80% of that. What would happen? Let me give you an example. Let's say, we'll use easy numbers. I'm purchasing a home for $100,000. $100,000 purchase price. And I'm getting an 80% loan to value loan. And it appraises for $95,000. Are they going to lend 80% of the $100,000 purchase price, or are they going to lend 80% of the $95,000 appraised value of the home? They're going to go with the lower one of those two numbers. Doesn't matter which one's lower, they're going to go with the lower one. So they're only going to lend 80% of the appraised value. Here's the thing, folks. Don't try to calculate your down payment by going, oh, it's 20% of. No. You calculate the loan amount, and then you subtract that from the purchase price, and that's your down payment, okay? So, for example, in this case, they're going to lend 80% of the $95,000, correct? So if I take $95,000 and multiply times 80%, how much is my loan amount? $76,000 for my loan. How much am I still paying for the property?
$100,000.
I'm still paying $100,000. And I'm borrowing $76,000, so what's my down payment going to be? $24,000 down. That's how you would calculate somebody's down payment if a property does not appraise. Yes.
Is the seller forced to lower down the price to the appraisal price?
So Sandy's question is the seller forced to lower the price to the appraised value? What would be the only way the seller could possibly be forced to do that?
They can not, I mean, they all gonna appraise pretty much the same, right?
No, that's not the question I asked. Stop beating around the bush. I asked you a direct question and I want a direct answer. What's the only way the seller can be forced to reduce to the appraised value? No, buyer not qualifying doesn't force the seller to do anything.
The home is only worth what the buyer.
No, that doesn't force the seller to do anything. That doesn't force them. That wanting to does not force them. What forces you to do things when you sign some document? A contract. So what's the only way the seller could be forced to reduce to the appraised value? If the contract they signed with the buyer says, I will reduce to the appraised value if it doesn't appraise. That's the only way. That's it. When we went through that standard offer to purchase and contract, you remember anything in there about the seller saying they would reduce to an appraised value? No, it's not there. So what's the answer to that question if we're using the standard offer to purchase and contract? Is the seller forced to? No. So, who's it on? It's on the buyer. What options under the standard offer to purchase and contract would they have? So now you're applying that knowledge you learned about the standard offer to purchase and contract. What options would the buyer have? Buy or don't buy. That's always their option, right? So it would probably depend what they wanted to do on whether or not they were still in what period of time?
Due diligence.
Their due diligence period. Because if they're still in their due diligence period, they cannot buy, and what would they get? A refund. Not all their money. Don't say all their money. The earnest money back. They're not going to get what back? The due diligence fee. But if they're in their due diligence period, they would still get a refund of their earnest money. What if they find this out after the due diligence period has expired? Oh well, they're going to forfeit not only the due diligence fee, but also the earnest money deposit. So, if you're a broker representing the buyer, what does that tell you about when you should have the appraisal done? As soon as possible, but in no case later than the what? The due diligence date. Because if it doesn't appraise, it doesn't matter. Because the contract doesn't specify that the seller has to do anything in relation to that appraised amount. They may choose to, but they don't have to.
Okay. That right there, is that for the purpose of the equity loan?
That's for the purpose of calculating how much I can borrow. So when the bank says, we will lend you 80% loan to value,
okay,
they're going to lend me 80% of either the purchase price or the appraised value, whichever one is lower.
Okay, but for a regular question, finding loan to value, we just multiply the 80% from the 100,000.
If that's the only number they give you.
But if they
give
give us
you both
the
numbers,
appraisal,
which
we
one?
go with the lower.
You go with the lower of the two. What if it appraises for more than the purchase price? Which one would you use?
The lower one?
The lower one. You always use the lower of the two.
Okay.
They're going to lend based on the lower of those two numbers. So if you had a question where they said, you know, Travis is getting an 80% loan to value loan on a $100,000 purchase and the property appraises for 95, you're going to use the 95.
Okay, cool.
That's the one little wrinkle. Does that make sense? Okay. Now, in that case, if that case happens out in today's world, which it does, the seller is going to have to decide how much do they want to cooperate with this buyer. Could they reduce to the appraised value? If they wanted to, sure. Is a lot of that going to depend on how they feel about, could I sell it to somebody else? Do I have another buyer? You know, how much do I want to close right now? It's all going to be, you know, dictated. Their response is going to be dictated based on what's going on in the transaction.
So, it's just an example, like if different buyers try to appraise that house in different prices, that would affect it too, right?
What do you mean?
Like the appraisals, like if there's two buyers and they want to get it appraised, but they're two total different prices, that would affect it too, right?
Two different prices, you mean like two different contracts?
Appraisals.
Two different appraisals?
Yeah.
How would it affect it? What do you mean?
I don't know. Because what if it's different appraisals? That's what I mean.
So what if it is? Who does that appraisal matter to?
The buyers.
Not plural.
Well, the bank.
That one buyer.
Yeah.
And they're one lender, right?
Yeah.
So if I have two buyers doing an appraisal on the same property, there's no overlap between the two. Could they have different appraised numbers? Sure. It's only going to impact them. Their appraisal is their appraisal. Their contract is their contract. Doesn't impact the other buyer at all.
So an appraisal is not a material fact.
Yeah, appraisal is not a material fact.
It's not.
Nope. Appraisal is not a material fact.
How much variance is there in like appraisals like that?
It's an opinion of value.
So
That
it
first
makes
word
no
should
difference.
tell you everything.
Okay.
It's an opinion. They're a lot like some other body part that we will not talk about, right? And everybody thinks everybody else stinks, right? Yes, there can be major variance.
Okay.
We'd like to think there wouldn't be, but there can be. They're opinions. It really depends on the type of property. Very similar properties in neighborhoods where there have been a lot of sales, you're going to get very similar appraisal numbers because you've got a lot of data.
Right.
What if you're appraising a house that's out in the country and there's not another house within 3 miles of it and nothing sold in the last 10 years within 10 miles of it?
Okay.
Because you have major variance in the opinion of value on that property. Sure.
So that's why it's not a material.
That's why it's not a material fact. Because it's exclusive to that buyer and that lender. That's it. So in this case, when this happens, using that standard offer to purchase and contract right now, usually would the buyer ask us to reduce to the appraised amount?
Yeah.
Of course, they'd be crazy not to ask, right? And what the seller says is largely going to be dictated based on, is the buyer still in their due diligence period? Because if the buyer's still in their due diligence period, we'd have to say, okay, well, if I say no, they're probably going to do what?
Back out.
They're going to back out, and I'm only going to keep their due diligence fee, and then I got to try to sell it to somebody else. If the buyer's already passed their due diligence period, what am I probably telling them?
No.
No. Because I'm just going to keep your earnest money deposit, and even if I have to sell it to somebody else for less, I'll keep your money, and I'll add that to whatever I get from the next person, and hopefully get me close to my amount. Does that
Now,
make
if the broker didn't do the appraisal within the due diligence period, then you go back to the broker and get your money if you're a buyer.
Could you sue, in other words, can I sue an agent who has not done a good job?
Yeah.
Then
Well,
the
at
answer
least
is
get a good
yes.
appraisal, if I lose my
Yeah,
money.
absolutely. If I'm the buyer and my broker doesn't make sure to point out to me that I need to have this appraisal done during that due diligence period, or otherwise I'm placing my earnest money at risk, I would say you could probably sue them. You still owe, it's not going to get you the money back from the seller, but could you sue your broker for it? Probably. Does that make sense? Everybody with me on that? Okay. Now, here's an even deeper question. Generic contract question. Not talking about our standard offer to purchase and contract. Generic contract question. What could we place in a contract that would protect a buyer against this? I'll give you a hint. It starts with the letter C. What can you place in a contract? A contingency. An appraisal contingency would go something like this. The house must appraise for at least the purchase price. Otherwise, the buyer can do what? Back out and get their money back. That would be an appraisal contingency, because a contingency is always the right to get out and get your money back if this doesn't happen. Now keep in mind, the standard offer to purchase and contract from the Association of Realtors doesn't have any contingencies in it. But if you got a generic question about a contingency, that's what you would use a contingency for, is to protect against something like this. Okay? Everybody good with that? All right. We talked about conforming loans already. They have maximum loan amounts. That's really what you need to know about a conforming loan. And then non-conforming loans are just ones that don't meet the conforming guidelines. We also have this phrase, a subprime loan. Subprime loans are loans that Fannie Mae will not buy because the borrower does not qualify. So like the loans we saw in our video about World Savings, those were all subprime loans. Because notice, where was all the risk? He even said, well, we weren't selling our risk to Wall Street. You know why they weren't selling it? Because they couldn't. Because they were all subprime loans. But Fannie wasn't dumb enough to buy them, but who was? Wachovia. Wachovia didn't buy the loans, they bought the whole damn bank. That worked out well for them, didn't it? Where's Wachovia these days?
Wells Fargo.
Yeah, at Wells Fargo, you have to go to Wells Fargo.
That one move sunk.
That one move, absolutely. It was a $50 billion hole, so it was a pretty big, bad move. Okay? PMI we talked about. You don't need to know the percentages, you just need to know, generally speaking, where does PMI kick in? At what loan to value am I going to have PMI? Over above 80% loan to value. Good. Okay? Let's stop there and do your lunch break. We'll come back at 1:30. Take a break, come back at 1:30.